You talk about defensives, but at the same time, of course, we have seen the likes of utilities, telecommunication services, real estate really getting smoked given the rising treasury yields. So where do we go for safety?
Nice to be back, Shery. I think for us, when we're looking at defenses, the places we're looking is healthcare facilities. So things like hospitals, providers of healthcare, because all through last year, people were not going to hospitals, but that trend has changed. We are looking selectively at telecom as well, but consumer staples is another area of focus. Consumer staples has underperformed consumer discretionary, but I think that is set to change now.
With rising yields, we have seen small caps starting to outperform, especially this GTV chart on the Bloomberg showing how they're really gaining ground against, say, large cap tech companies as treasury yields rise, which is the line in blue. When you look at this trend, do we have more to go for these small cap stocks that perhaps could be more vulnerable to economic changes?
I think so, yes. And I think if you have a similar chart for emerging markets or for China, you will see that that trend is even more extreme. And that's because in China, the large caps, as you know, have been hit by very strong regulatory pressure. And so year to date, small caps in China have outperformed by almost 18% because they have less regulatory pressure. They're benefiting from the COVID recovery plan, and monetary stimulus is more in smaller caps in China. So yes, I think that trend could continue.
Well, China's dealing with a number of other issues as well. It had some terrible PMI numbers yesterday, the energy crisis. Do you anticipate seeing some support coming from the PBOC?
Yes, and we saw some news on Evergrande last night, right? I think the Chinese government is in a very tough situation compared to where it's been in the last 10 years, where it's trying to balance economic growth, emissions, as well as social prosperity. I think you will see over the next few years an expansion of the state-owned enterprises because the government will come in to support property, financials, NPLs. And I think you're right that the PBOC will intervene to support the real economy, if not the markets.
We've been seeing a lot of dollar strength, but no corresponding weakness in the offshore yuan. It's pretty much where it was about a month ago. Do you see any pressure coming for the RMB?
I think actually the fact that the yuan has stayed where it has made it difficult for China from a peer group basis, meaning their exports are less competitive than they were 3 months ago. And a lot of the economic growth in China over the last quarter was still driven by exports. So the fact that the yuan is where it is going to be a headwind for them the next few months on a relative basis compared to other export-oriented economies.
And the power crunch, will that lead to more action from policymakers?
I think that's a fine line, right? I think between economic growth and emissions, that's the balance they're trying to find. You saw earlier today where they're announcing that they want to increase power supply at any cost. So yes, there will be more regulation, I think. But for China to reach its emission goals, certain industries will have to be shut down for a certain period of time. So I do think there's more volatility in China going forward.